This is one of those topics that reveal something deeper. When silver drops $9 in a single trading session, the financial media scrambles to explain it away with sanitized narratives about profit-taking or market corrections. But what really happened on that day wasn't just a market move. It was a coordinated takedown, executed with surgical precision by institutions that have been playing this game far longer than most retail investors have been alive. The date was February 28th, 2024. Silver had been climbing steadily, building momentum as inflation fears mounted and investors fled from increasingly worthless paper currencies. Then, in the span of just a few hours during Asian trading, the metal was absolutely demolished. $9. That's roughly a 30% crash in a commodity market that's supposed to be governed by supply and demand fundamentals. Let that sink in. Now, before we dive into the mechanics of what actually transpired, we need to understand something fundamental about the silver market that Wall Street desperately doesn't want you to grasp. Silver isn't like stocks or bonds. It's not a derivative of confidence or future earnings potential. It's actual physical metal that's been considered money for over 5,000 years of human civilization. When the price moves this violently, this quickly, in a market that trades around the clock across multiple continents, you're not witnessing natural price discovery. You're watching financial engineering. The silver market has always been the most manipulated corner of the commodity world. And that's not conspiracy theory, that's documented fact. JP Morgan paid nearly $1 billion in fines for spoofing the precious metals markets. Deutsche Bank, HSBC, Scotiabank, they've all settled cases related to rigging silver prices. These aren't isolated incidents. They represent a systematic approach to controlling an asset that, if allowed to reflect its true value based on supply-demand fundamentals, would expose the fragility of the entire fiat currency system. Here's the crucial part. The mechanism they use is something called the paper silver market. For every ounce of physical silver that actually exists in vaults, there are estimates ranging from 100 to 500 paper claims on that same ounce. Think about that structure for a moment. It's the same fractional reserve scam that banks run with deposits, except applied to a commodity market. The COMEX, the London bullion market, the various ETFs, they're all trading contracts and shares that represent silver, but most of it doesn't physically exist in the quantities claimed. On that day in February, someone, and by someone I mean institutional players with access to massive leverage and inside information about order flow, dumped an absolutely staggering amount of paper silver contracts onto the market during the thinnest trading hours. We're talking about the equivalent of hundreds of millions of ounces being sold in minutes. No rational economic actor sells that way if their goal is to get the best price for their holdings. You only sell like that if your objective is to deliberately crash the price. The timing was surgical. Asian markets, lower liquidity, fewer participants to absorb the selling pressure. Algorithmic trading systems saw the massive volume, interpreted it as a bearish signal, and began their own programmed selling. Stop losses got triggered in cascading waves. Margin calls forced leveraged long positions to liquidate. Within hours, the price had been driven down so violently that it wiped out months of gains and shook out anyone who was not holding physical metal with conviction. What's fascinating is, this wasn't even the first time. This exact pattern has played out repeatedly throughout modern silver market history. The Hunt brothers in 1980 got crushed by coordinated exchange rule changes when silver threatened to break free from institutional control. In 2011, when silver was approaching $50 per ounce and threatening to expose the currency debasement policies of central banks worldwide, we saw similar margin requirement increases and coordinated selling that knocked the price down by 30% in a matter of days. In 2020, during the initial COVID panic, silver was smashed down alongside a desperate rush for dollars as the entire global financial system seized up. Each time, the narrative is different. Each time, the mainstream financial press publishes explanations that sound superficially plausible if you don't understand the underlying mechanics. But the pattern is identical. Silver builds momentum, threatens to break through key psychological and technical levels, and then gets absolutely destroyed by concentrated selling during illiquid trading windows. Now, let's talk about who benefits from this arrangement. The commercial banks that dominate the COMEX precious metals trading are consistently positioned short on silver. They're not hedging mining operations or industrial consumption. They're taking naked short positions, selling silver they do not own, and then using their market power and information advantages to drive prices down to profit from those positions. This isn't speculation. The commitments of traders' reports, published weekly by the CFTC, show these concentrated short positions clearly. When you hold a massive short position and you have access to enormous capital, you can temporarily override market fundamentals through sheer force. It's expensive, sure. Selling hundreds of millions of ounces of paper silver at increasingly lower prices means taking losses on each contract sold. But if your ultimate goal is to close out existing short positions at much lower prices, or to acquire physical metal at suppressed levels, or simply to prevent silver from rising to levels that would trigger broader questions about currency stability, the cost becomes acceptable. This is where everything comes together. The February crash didn't happen in isolation. Look at what else was occurring in global markets at that time. The dollar was under pressure. Gold was making new highs. Bitcoin was rallying. The Treasury market was showing signs of stress with volatile yields. Inflation data kept coming in hotter than official forecasts. Regional banks were still dealing with unrealized losses on their bond portfolios. The entire financial architecture that's been erected since 2008 was showing cracks. Silver, more than almost any other asset, serves as a barometer of confidence in the monetary system. It's not just an industrial metal, though it certainly has critical applications in electronics, solar panels, and emerging technologies. It's also monetary metal, poor man's gold, the asset that ordinary people throughout history have turned to when paper currency systems fail. When silver starts moving aggressively higher, it sends a signal that confidence in fiat currencies and the institutions that manage them is eroding. The powers that manage our financial system cannot allow that signal to proliferate unchecked. They need the public to maintain faith in paper currencies, in government bonds, in the sustainability of deficit spending, and endless monetary expansion. A silver price that's rising sharply and attracting mainstream attention becomes a threat to that narrative. It suggests that maybe, just maybe, the emperor has no clothes, that the purchasing power of your savings is being systematically destroyed, that the metrics they use to measure inflation are rigged to understate reality, so they smash it. They use the paper market leverage to override the physical market fundamentals, at least temporarily. They trigger selling cascades that wipe out speculators and shake the confidence of new investors who just watch their positions get destroyed. They generate headlines about silver's volatility and risk that discourage broader participation. And most importantly, they reassert control over a market that was threatening to escape their influence. Here's what you need to understand about the physical reality underlying all this paper manipulation. Global silver supply has been running deficits for several years now. Industrial demand continues growing, particularly for solar panels and electric vehicle components. Investment demand surges whenever people lose faith in traditional financial assets. Meanwhile, above-ground stockpiles have been depleted over decades. Primary mining production struggles to expand significantly because most silver comes as a byproduct of other mining operations, and recycling only covers a fraction of demand. These are the fundamentals that would normally drive prices higher in any rationally functioning market. But the silver market doesn't function rationally because the paper tail wags the physical dog. The price discovery mechanism happens predominantly in futures markets and ETFs, where no physical metal changes hands, rather than in the actual physical market where real metal gets bought and sold. This inversion creates the opportunity for manipulation. Now, let me be clear about something. Manipulation cannot last forever. The gap between paper price and physical reality can only stretch so far before something breaks. We've seen hints of this stress building. During the 2020 crisis, physical premiums on silver coins and bars exploded to 40, 50, even 60% above spot price. Dealers couldn't source metal despite the paper price suggesting abundance. Delivery delays stretched to months. The disconnect was obvious to anyone actually trying to buy physical silver. The February 2024 smash created similar dynamics. As the paper price crashed, physical buyers stepped in aggressively. Coin dealers reported surging demand. Premiums widened. The very institutions that benefit from suppressing prices found themselves facing actual delivery requests that required sourcing real metal. Because here's the dirty secret they don't want getting out. When the price gets smashed this hard, it actually creates a credibility problem for the paper market. Think about it from the perspective of someone holding a silver ETF or futures contract. You're told that you own silver, that your shares or contracts represent real metal stored in vaults somewhere. Then you watch the price crash 30% in hours despite no fundamental change in supply or demand. Either you believe that silver's true value just evaporated inexplicably, or you start questioning whether that paper claim you're holding is really backed by physical metal at all. Some people get scared and sell. But others, particularly those who understand the game being played, start demanding physical delivery. This is the Achilles heel of the manipulation scheme. Paper can be created infinitely. Physical metal cannot. Every paper contract that converts to physical delivery drains the available inventory and exposes the fractional reserve nature of the system. The manipulators need most participants to stay in paper, to trade in and out based on price movements without ever taking delivery. When too many people simultaneously demand the actual metal, the whole structure gets stressed. What happened in the days and weeks following the February crash was telling. Official inventory levels at COMEX warehouses started declining. Registered silver, The portion actually available for delivery dropped significantly as existing holders moved metal into allocated storage or took possession entirely. Meanwhile, the open interest in futures contracts remained elevated, meaning the ratio of paper claims to physical metal got even more stretched. The mainstream financial media barely covered any of this, of course. A $9 single-day crash in silver might get a brief mention, but there's no follow-up analysis about the mechanics, no investigation into who sold and why, no examination of whether the price movement reflected genuine market forces or manipulation. They report what happened and move on, leaving most people with the impression that silver is just volatile and unpredictable. But the informed insiders know exactly what happened. They've seen this playbook executed repeatedly. They understand that these dramatic smashes serve multiple purposes beyond just profiting on short positions. They reset technical charts, breaking through support levels that traders rely on. They trigger fear and capitulation among newer investors. They create buying opportunities for those with patient capital and long time horizons. And most importantly, they reassert institutional control over a market that threatens the broader financial narrative. Let that sink in for a moment. We live in a system where the price of money itself, because silver is money, regardless of what modern economists claim, can be manipulated by institutions with sufficient leverage and access. Where the visible price you see quoted doesn't reflect actual supply and demand for the physical asset, but rather the outcome of algorithmic warfare and concentrated positioning in derivative markets, where regulatory agencies that are supposed to ensure fair and orderly markets either can't or won't stop obvious manipulation that's been ongoing for decades. This isn't some fringe conspiracy theory. This is documented, settled legal fact. The banks have admitted wrongdoing, paid fines, and continue doing exactly the same thing, because the profits from manipulation exceed the penalties for getting caught. It's a rational business decision in a system where regulatory capture ensures that the punishments never fit the crimes. So what does this mean for you, for anyone trying to navigate financial markets and protect their wealth? First, understand that paper silver and physical silver are increasingly divergent assets. The paper price will continue being subject to these manipulation events. If you own ETFs or futures contracts, you need to accept that your positions can be destroyed overnight by coordinated institutional selling that has nothing to do with silver's actual value. That's the risk you take playing in their rigged casino. Physical silver, conversely, becomes more valuable precisely because of this manipulation. Every time they smash the price, they create buying opportunities for those accumulating real metal. The lower they drive the paper price, the faster physical inventory gets absorbed by buyers who understand the disconnect. Eventually, and we're seeing signs this is approaching, the physical market will divorce from the paper market entirely. When that happens, when the paper price loses credibility because too many people demand delivery and expose the fractional reserve scam, the reset will be dramatic. The bottom line is this: the February 2024 crash was neither random nor driven by fundamentals. It was a coordinated operation to suppress silver prices and shake out weak hands. The same institutions that have been rigging this market for decades executed another takedown using the same playbook they've always used. They sold massive quantities of paper silver during thin trading hours, triggered algorithmic selling and stop losses, and drove the price down by 30% in a matter of hours. But here's what they can't do. They can't create physical silver out of thin air. They can't change the underlying supply deficit or growing industrial demand. They can't prevent people from recognizing that fiat currencies are being systematically debased and seeking alternatives. Most importantly, they can't maintain the paper manipulation scheme indefinitely as more people wake up to the reality of what's happening and demand physical metal instead of paper promises. The crash was real. The losses for leveraged traders were real. But the opportunity created for those who understand what's actually happening was equally real. This is what you need to know. Price is what you pay. Value is what you get. The paper price of silver was crashed $9 that day, but the value of silver as a monetary metal, as an industrial commodity, as a store of wealth outside the banking system, didn't change at all. They smashed it because they had to, because silver was threatening to expose truths they need to keep hidden, because the alternative was allowing a market signal to propagate that would undermine confidence in the entire fiat currency system. So they deployed their leverage, executed their manipulation, and crashed the price. But in doing so, they also revealed their desperation and the fragility of the system they're trying to protect. For those paying attention, for those who see through the mainstream narratives and understand the game being played, that day wasn't a disaster. It was confirmation. Confirmation that silver matters enough to manipulate. Confirmation that the institutions are terrified of what an honest silver market would reveal. Confirmation that physical metal, held outside the banking system, remains one of the few assets they can't ultimately control. The paper price will continue being volatile because manipulation will continue. But the divergence between paper and physical grows wider with each operation. And eventually, inevitably, reality reasserts itself. Physics beats finance. The physical market overwhelms the paper market. And when that day comes, those holding real metal will understand exactly why they endured the volatility and manipulation. Because they owned something real in a world of increasingly obvious illusions. That's what the $9 crash was really about. Not market forces or profit-taking or any of the sanitized explanations you heard. It was about power, control, and the desperate attempt to maintain a system that's fundamentally unsustainable. They can smash the price, but they can't change reality, and reality, eventually, always wins.